How does a $1.1 billion acquisition impact the landscape of Manhattan's office market? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In a landmark deal for Manhattan, New York, real estate investment firm RXR has purchased the 42-story Class A skyscraper at 590 Madison Avenue for approximately $1.1 billion. This acquisition marks the largest Manhattan office space purchase in over 3 years. The sale price is the highest seen in the New York City office market since Google's parent company, Alphabet, acquired 550 Washington Street for nearly $2 billion in 2022. The property, previously known as the IBM Building, was sold by the State Teachers Retirement System of Ohio, which had owned it for almost 30 years after acquiring it for $202 million. Notably, the Madison Avenue property, situated in the prestigious Plaza District, has been a hub for high-end leasing. According to RXR, the building has drawn more than 300,000 square feet in new leases in recent months, demonstrating strong demand for prime locations. The building has undergone more than $100 million in renovations, including a new $400+ million, 21,000 square foot amenity suite known as the Madison Avenue Club. Tenants include Apollo Global Management, which signed a 96,000 square foot lease in April, as well as Tiger Management and Louis Vuitton. Additionally, the ground floor retail space features high street retail exposure, with a tenant roster that includes luxury jeweler Bucherer. In a separate announcement, RXR revealed an expanded partnership with Liberty Mutual Investments, through which they plan to deploy $1 billion for credit opportunities, including senior loans and construction financing. However, the 590 Madison Avenue acquisition itself was a partnership with Elliott Investment Management and was financed with a senior mortgage from Apollo Global Management. Still Secured represented the seller, while Newmark advised RXR on equity capital. Real estate experts are closely watching this purchase as a sign of renewed faith in Manhattan's top-tier office market. RXR stated that the deal fits its office recovery strategy, which involves buying Class A and trophy properties at a discount. The firm believes these assets will become long-term winners, especially as the supply of quality office space in Manhattan shrinks and demand remains strong. Dragos Capital, a renowned privately held investment firm, has recently expanded its portfolio by acquiring a selection of retail properties featuring 18 CVS tenancies. This strategic move marks a pivotal moment in the firm's efforts to enhance its presence in the triple-net lease real estate sector. The newly acquired portfolio comprises properties that are secured by long-term leases with CVS Health, a prominent leader in health solutions across the United States. This alignment with a well-established tenant exemplifies Dragos Capital's strategy of investing in credit tenant real estate. The firm aims to generate consistent income streams while benefiting from robust tenant profiles and the potential for significant long-term appreciation in property values. Moreover, Dragos Capital forms strategic partnerships with distinguished real estate groups, 1,031 exchange investors, and seasoned long-term property owners. With these collaborations, the firm focuses on acquiring triple-net lease assets, self-storage facilities, and other strategic commercial properties that are backed by reputable credit tenants, ensuring a stable and lucrative investment landscape. Keith Fields, managing partner of Dragos Capital, emphasized the firm's commitment to identifying high-quality real estate opportunities that deliver reliable cash flow and strong tenant profiles. He stated that these acquisitions are foundational for sustainable returns and long-term capital preservation. Leveraging big data is transforming the way commercial properties are identified and evaluated. Gone are the days when property decisions were based solely on intuition and relationships. Today, the commercial real estate industry is shifting towards a data-driven approach, where big data analytics plays a pivotal role in property searches and investment strategies. Traditional methods of commercial property search involved manually scouring listings, often leading to missed opportunities. Properties could be listed as available despite being under contract for weeks. The inefficiencies of such methods cost real money and opportunities every day. Moreover, critical data such as zoning information, foot traffic patterns, and tax incentives were scattered across different sources, requiring exhaustive effort to compile. Big data, however, integrates vast amounts of information such as occupancy rates, leasing histories, and demographic changes, providing a comprehensive view of the market landscape. This data is processed through algorithms capable of identifying patterns that might go unnoticed by human analysis. According to commercialobserver.com, this shift is fundamentally changing how professionals evaluate investment risks and streamline acquisitions. Key datasets that provide a competitive edge include demographic intelligence, mobile location data, and Internet of Things sensor data. These datasets help in making informed decisions about site selection, demand forecasting, and market analysis. For instance, using demographic data, a retailer can identify emerging neighborhoods poised for growth, while mobile location data can reveal actual foot traffic patterns that may not be apparent during site visits. Predictive analytics further enhances decision-making by allowing professionals to forecast market trends, assess investment viability, and mitigate risks. This data-driven approach ensures that decisions are not just reactive, but anticipatory, providing a strategic advantage in a competitive market. For example, predictive analytics can indicate which areas are likely to experience rental rate increases, guiding investment strategies accordingly. To implement a data-driven approach, platforms like Reonomy, Placer.ai, and CompStack offer valuable tools for property research, foot traffic analysis, and lease comparables, respectively. These platforms help streamline the property search process, enabling professionals to make decisions based on robust data rather than assumptions. Starting with one or two platforms and expanding as needed is recommended for those new to big data analytics. While big data provides significant advantages, it also raises challenges such as data bias and privacy concerns. Not all data is objective, and algorithms can be biased, leading to flawed conclusions. It is crucial to understand the sourcing methodology of data and ensure compliance with privacy regulations like the General Data Protection Regulation and the California Consumer Privacy Act. Ultimately, the integration of big data in commercial real estate is not merely a trend, but a necessity for staying competitive. Professionals who harness the power of data to gain insights and make informed decisions are better positioned to capitalize on market opportunities and avoid costly missteps. In Farragut, Tennessee, the Municipal Planning Commission has given the green light for a new commercial development along Kingston Pike. This approval encompasses 4 new buildings at the intersection of Kingston Pike and South Watt Road. The planned structures will host 9 new businesses, including a Starbucks, an Edward Jones Financial Office, a Pacific Dental Office, and a Covenant Health primary care physician. Additionally, there are 4 more spaces designated for retail or restaurant use. During the Commission's meeting, it was noted that a traffic impact study will be conducted to assess the need for a new traffic signal at the site. The Commission unanimously approved the site plan, reflecting a 7-0 vote in favor. This development is part of a broader trend of commercial expansion in the area, aiming to boost local economic growth and provide more amenities for residents. In recent developments within Onondaga County, significant commercial and residential property transactions have been recorded, shedding light on the area's dynamic real estate landscape. From August 10th to 16th, a total of 27 notable sales were documented, ranging from vacant commercial spaces to multifamily residences. For instance, a vacant commercial property at 1227 Milton Avenue in Syracuse was sold by the Greater Syracuse Property Development Corporation to Visinia Limited Liability Company for $976, while a similar transaction occurred at 201 South Beach Street, transferring ownership from the Greater Syracuse Business Development Corporation to Leos Real Estate Rental Incorporated for the same amount. The mid-range transactions included a 2-family residence at 3607 South Salina Street and Matson Avenue in Syracuse, purchased by Sear Properties Limited Liability Company for $65,000. Additionally, a commercial one-use small building at 2803 Brewerton Road in Salina was acquired by Durant Group Limited Liability Company for $165,000. Higher value deals were also prominent, such as the sale of a commercial storage facility at 1200 Burnett Avenue in Syracuse, which changed hands from UPM Limited Liability Company to Patrick Foll for $505,000. Moreover, A significant transaction involved a commercial warehouse and self-storage facility at 8372 Oswego Road in Clay, sold by Lafayette Acquisitions Limited Liability Company to Ridian Yard Clay Limited Liability Company for $5,600,000. These transactions reflect a broad spectrum of property types and values, highlighting the varied investment opportunities within Onondaga County. The real estate market here presents diverse options for investors, from affordable residential properties to high-value commercial assets. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.